Okay, that's a bit better numbers wise. Everyone's obviously got out of bed now, so we're all right. We're all right. Okay. Good morning, everybody. My name is Esther. I'm going to be chairing this webinar this morning, and we're going to be talking about shaping your payroll to reward your people. So if you thought we were talking about doing business in China, then you are in the wrong place. So lots of familiar names on the delegate list this morning. Lots of repeat attendees for our webinars, which is great. So lots of you very familiar with who we are, but for those of you who are less familiar, MKS is a top 15 audit, tax and advisory firm. We work with entrepreneurial businesses across all different sectors, as well as not-for-profit and private clients. We're also part of More Global, which is an international network with presence in over 100 countries, so very well placed to help clients with their international endeavours. So this morning in this webinar, our experts will be explaining to us the recent changes that could potentially impact your payroll software, and what to consider when you're looking at your total reward statement. So I'm delighted to be joined by Adam Flight, who is our Director of Payroll, and Sally Elcom, who is Head of Reward at Moore Kingston Smith. So Adam is a Director of Payroll at Moore Kingston Smith. His main career background is in HR, having worked within the industry for more than 20 years. And for the last 5 years, he's been heading up our payroll bureau team, who together processes payrolls for more than 1,000 different clients, with employee numbers ranging from 1 to more than 3,000. So no size criteria there, and producing more than 22,000 payslips a month. And Sally is Head of Reward Services at Moore Kingston Smith People Advisory, and she has over 25 years experience in total reward management. She's worked alongside existing HR and reward teams, and shares expertise and experience in developing creative and sustainable reward solutions. So I'm going to do a little bit of light sharing and be asking our panelists some questions, but just a little bit of housekeeping before I start. Please do ask questions. It's much more interesting if you ask questions. It's much more interactive, and I think you get more out of it. So please do ask questions, but please pop them in the Q&A function, because that's where it's easier to keep track of them. So don't put them in the chat, put them in the Q&A function. And I'll try and weave those questions in as we go along. And if there's any unanswered at the end of the session, then we can pick those up with you directly. The session is being recorded. So if any of your peers or colleagues or contacts haven't been able to watch it, or you think they might be interested, then please do share it with them. And there will be a little survey at the end just to get your thoughts on the webinar and future webinars. Please do fill that out. It only takes literally probably less than a minute, and it's super helpful in helping us shape future webinars. And this is the last webinar in our series for this year. So we'll be returning in January with a session on year-end tax planning. So please do join us for that one. So Adam, I think we'll start with some questions for you. Tell us a bit about what sort of the upcoming payroll changes are, and what people need to be aware of in the next sort of 6 months or so.
Thank you, Esther. So probably the first and most imminent change that's going to be coming up is the change to national insurance. And there are a couple of things to remember here. So first, there's going to be a cut from the main rate of national insurance paid by your employees from 12% to 10%. And this is going to be effective from the 6th of January, not from the 6th of April, as most changes come in. So with less than sort of 2 or 3 weeks to go, for those of you who are either operating with an outsourced provider or run their payroll in-house, you will need to make sure that your software has been updated in time for when you run the payroll in January. Otherwise, you'll have to sort of backdate things when you run things sort of in February. So no time like the present. Please ensure that you have contacted whoever runs your payroll or the software company to make sure when that update is going to be ready for you to implement and install. But just to give you some examples of how that national insurance rate cut will affect your employees. So typically someone who's on a gross salary of £20,000 will save around £148 a year. The average salary of 35,400, employees will save £450 a year, all the way up to someone who's earning 65,000 will save around £750. So this means that a family with 2 people both earning on average 35,400 will have a combined saving of £900, which is certainly not insignificant. Is a nice thing to sort of be able to look forward to in the new year. And I'm sure that given the cost of living crisis at the moment, sort of every penny counts, and that will certainly make a difference to a lot of people when it comes to their net pay at the end of the day. And then, so looking forward, we've got changes to national minimum wage. So one of the first changes is that they've scrapped the 23 and over rate. So the top rate now starts from everyone aged 21 and above. And that new rate will be increasing by £1.02 to £11.44. So that's a 9.8% increase. 18 to 20-year-olds will see a £1.11 increase to £8.60. 16 to 17-year-olds will see a £1.12 increase to £6.40, and the apprenticeship rate as well is at £6.40. So what you've got to consider there is that if you've got anyone who's currently sort of sat at the age of 22 and you think, well, they're not 23 yet, so they won't be earning that sort of higher rate yet. Well, from the 6th of April, anyone that's sort of over the age of 21 on minimum wage and working a 40-hour week will actually see their annual pay increase by more than £2,000. So they'll go from earning £21,673 to £23,795. So that's a significant cost that I would say if you're looking at budgets now for the 2024-25 year, it's certainly something that you need to take into consideration and see how many people sort of that affects. And then the final one, which was announced earlier this year, but we haven't got a date yet, is the changes to pension thresholds. And this is mainly for the qualifying earnings pensions, which is generally the default settings when people set up their workplace pensions. And effectively, the lower earnings limit is going to be removed, meaning that employees in a pension scheme will be auto-enrolled sort of from the first pound that they start earning. And also, the age at which they become eligible is going to be dropped from 22 to the age of 18. So as I said, whilst there's no date set, the likelihood is it will probably come into effect from the 6th of April 2025. And the impact this could have with regards to sort of real costs is that whilst, yes, it's all good that employees and employers will be contributing more into pension schemes, which is obviously a good thing, in real time sort of money, this will mean that employees who are paying 3% contributions, employees that are paying 5% contributions will see sort of an increase of £312 per annum sort of going into their pot, and employers paying 3% will see an increase of £187 being paid into the pot. So whilst it's good that they're saving, there is a possibility it may deter people from being in an auto-enrollment scheme and may possibly mean that they opt out. But I would like to think that sort of for employees, an extra sort of £25, given that they're saving on their national insurance contributions moving forward, will sort of continue paying into their pension pot. But again, it's an additional employer cost as well as national insurance, national minimum wage. So it's certainly something to start budgeting for. So that's everything for now, Esther, that I can think of that payroll changes within the next few months.
Yeah, like you say, hopefully the national insurance savings will offset some of those extra pension costs for employees, because obviously very important to start paying into a pension as early as possible and getting into the routine of doing that. So, I mean, we're fast approaching the December or Christmas payroll, as some like to call it. What are the sort of the key things that people need to be thinking about as we approach that?
Yeah, so we get asked this question sort of quite a bit. So when we contact our clients around about October, November time every year, and about 90% of clients who pay typically between the 25th and the last working day of the month tend to pay earlier. So our team are currently sort of working flat out at the moment, trying to process everything for payday on the 22nd of December or earlier. But the one thing that you really must be careful and mindful of when making earlier payments, because this could cause issues for employees who are receiving any benefits from the government, like universal credit, child benefit, is to make sure that when you're doing the submission to HMRC, you keep the payment date as it would be normally. So if you pay on the 26th of the month, make sure that the payment date shown on your submission to HMRC remains the 26th. If you change it to an earlier one, then it will mess things up with government departments. They will think that an employee has been paid twice within the same pay period, and it may mean that it then nulls and voids their entitlement to universal credit or child benefit, and that could take several months to actually rectify. So that's certainly the most key thing I can think of sort of when it comes to preparing for Christmas payroll.
I had a question come in sort of a cross between the two different things we've been talking about in terms of NI and Christmas bonuses. Somebody's talking about is saying, should we be delaying them until January so that we save the 2% NI?
It depends is the answer, and I'm sure Sally can probably sort of jump in as well. Realistically, it all depends what it states in people's employment contracts. If every single year, and it's either become customer practice or it says in their contracts that they will get paid in December, you certainly should, unless you've consulted with your employees and got their agreement to defer it by a month, then you certainly should pay it in December. At this time of year, everyone's spending has gone up, and they may be counting on that bonus to cover the cost of Christmas and everything else. So I would probably say it would be better to carry on paying it, because whilst, yes, you could save that 2%, the saving on that 2% may not actually outweigh the need for being paid that money sort of as and when earlier. And the last thing you want to be is in breach of contract if employees are guaranteed normally to be paid in December.
There's more with under consultation. If an employee is happy to delay it, then you could pay it in January, but otherwise it's probably not sensible, because the whole point of Christmas bonus is like you say, everyone needs the cash, so they'd probably prefer to have it now and suffer the extra 2%. I've got another question come in saying, with 2024 pay rises on the horizon, some employees will nudge over the 100,000 per annum, and I'm told this could mean a reduction rather than an increase in their take-home pay due to losing the tax-free threshold. Is this true, and what advice can I give to counteract this?
So there are a couple of options. So if they do tip over the 100,000, then yes, their personal tax-free allowance sort of will be removed. So effectively, they're then paying tax on the larger amount. Some people, and it's certainly a consideration when looking at pensions and anything to do with salary sacrifice, if you've got a pension salary sacrifice scheme, then some people are willing to sacrifice more of their salary to keep their annual earnings under that £100,000 sort of tax threshold, so that they can still take full advantage of that tax-free element whilst paying a lot more into their pension scheme. And so it's a bit of a win-win. Obviously, if you can afford to do that, then it certainly makes sense to do that. But generally, that's probably one of the only things that you can implement. But also, you can only implement it if you have a salary sacrifice scheme in place. If you don't, it's certainly worth looking into, because of the NI savings for both employees and employers. Salary sacrifice is certainly the way to go, and seems to be becoming a lot more common nowadays. Employers and employees becoming very savvy about pensions and what they should and shouldn't be doing. And more often than not, employers set up salary sacrifice schemes on the basis that employees have actually gone to them and requested it. And it's when they actually look into the cost savings that both they and their employees will make by having such a scheme, that they say it's a bit of a no-brainer.
Okay, fair enough. We hear sort of sometimes about audits of payrolls. It's not something you hear about too much, but from time to time we do. But what reasons are there why businesses should perform audits of their payrolls?
So there are a couple of reasons. First off, it all depends whether you outsource or do the payroll in-house. If you outsource and you've remained with the same provider, sometimes it's worth just checking, because a provider may have set up a payroll many, many years ago for you. There often changes internally with different finance directors or CFOs or different HR directors that sort of come in, and just it's these types of things. And I'll go through a little bit of a checklist to go through, and it doesn't matter whether you outsource it or whether you look at it sort of in-house. So first of all is checking and sanitizing your employee data, making sure that employee start date, date of birth, and NI numbers are correct, because you could be going along blissfully processing payrolls, have someone's NI number sort of incorrect or date of birth incorrect, and all of those national insurance contributions you're actually paying across go into somewhere within HMRC and are just sitting there and not actually allocated against the person's national insurance record. And we've had numerous cases over the last couple of years where we've had to write to HMRC on behalf of clients and inform them of the incorrect NI number with the correct NI number and get them to allocate however much into that person's sort of national insurance pot. The other thing to check is salaries and hours of work to make sure that things have been prorated correctly. You'd be surprised how many different ways clients and sort of people internally, when you ask them how you prorata a salary, come up with different answers. So making sure that that's consistent across the board, making sure that tax codes are correct. Most software, most payroll softwares now, you can link directly to HMRC. So every time you open the run each week or each month, it will automatically download the latest tax code. But if it doesn't, then just make sure that you're contacting your employees so that if they do get any tax code notifications, they provide you with a copy so that their tax code's correct. Tax treatment of pay components. This is quite a critical one because some people think everything's taxable and NIable when some things may be taxable but not NIable. Some things employers send to us and go, oh, we want to put this through completely tax-free. And we go, I'm afraid you can't put that through tax-free. And if you do, then HMRC may come knocking and then it may open a whole can of worms and you may end up with a HMRC audit, which is certainly the last thing to do. And then the final thing, as I've mentioned previously, is the pension scheme. And a shocking statistic that sort of I learned earlier this year is that of the payrolls that we take on for clients, either from an in-house team or from other providers, 45% of them, we take on over 100 clients a year, 45% of payrolls we take on have errors in the way that the pension scheme has been set up and deductions are made. Now, obviously, there are two ways that errors can be made. Is one, you could be over-deducting and over-contributing into employees' pension schemes, which is certainly a better error to have than underpaying, because if you were to correct it, then it means that employees are going to then end up with more net pay, or they may turn around and go, well, I'm so used to paying that level of contribution, I'm happy to continue, and effectively they've got more in their pension pot. The worst way is if you're under-contributing, because if you then have to backdate things by several years, the liability as an employer to actually top those pension contributions up could run into the tens of thousands, and it's certainly something sort of worth looking into. So those are the main reasons for doing payroll audits. It's just making sure that you've got your house in order, and it's just making sure that you don't find out in a few years' time that whatever liability there may be now isn't even greater sort of at a later date.
And somebody's asked, what should we do if our pension has been set up incorrectly? How do you go about rectifying that?
So there are a couple of ways. So if you run the pension in-house, then you can either go to an independent financial advisor or the person who you went to originally to set up the pension scheme, and ask them for support and assistance. Yes, you probably will need to provide them with several years worth of payroll data, but it's not something that can be done sort of overnight. It does take a bit of time. There may be additional cost involved in getting someone externally to look at it. Or alternatively, you could speak, if you outsource it, you could look at your payroll provider and ask them for support and assistance in sort of recalculating things. Sometimes it may be because the payroll provider has set it up incorrectly, in which case sometimes payroll providers will have professional indemnity insurance or something like that to cover sort of that error so that they foot the bill. But more often than not, it's through to an initial lack of understanding of pension schemes and how they're set up. And sometimes payroll providers such as us do get given the wrong information by clients and set it up based on an email without actually seeing the scheme sort of rules and details. But it's nothing that can't be sort of overcome. It's just something that isn't an overnight fix and could take a month or two to look into and get corrected.
Lovely, thank you. And what about sort of 2024 and beyond? What are we sort of, what's that going to look like in the world of payroll?
There are a couple of things. So one thing that's been around now for around about sort of 5 or 6 years is the payrolling of benefits. So if you provide private medical insurance or anything else that's a company paid benefit that you would normally report on a P11D, you can payroll those benefits. So if you register with HMRC before the 31st of March 2024, from April, you can actually payroll that benefit. Now, the difference between payrolling the benefit and reporting on a P11D is you're actually reporting in real time. So you're putting that deduction through, and the correct tax treatment is being sort of taking effect every single month that the payroll is being run. So that if people join, start, leave, the different benefits, it's happening as it actually sort of happens. Whereas when you do a P11D, you're reporting on the last tax year. Now, the P11D deadline is the 6th of July each year, and then normally HMRC send through updated tax codes around August, September time, and then they collect the tax owed on that in the remaining sort of 6 or 7 months of the tax year. Now, in the first year that you implement payrolling of benefits, yes, there's going to be a bit of a double tax hit because you will be implementing payrolling of benefits from April, but you'll also still have to produce a P11D next July, June, July, for this current tax year. But if you speak to tax advisors or your payroll provider, they can support and assist you with that, give you some illustrations as to what that will look like for the employees so that you can do some communications. But it's certainly sort of much easier to payroll benefits than it is to collate all of that information. The second one is holiday pay. For those of you that have sort of weekly and hourly paid sort of staff, I'm sure looking back over the last 52 weeks and looking at what they've earned and trying to work out what holiday pay they're due has been an absolute nightmare. Thankfully, common sense has finally prevailed. And from the 1st of April 2024, employers will be permitted to calculate annual leave entitlement based on 12.07% of the hours worked in a pay period for irregular hours workers and part-year workers. So it goes back to how it was done previously. Obviously, it doesn't apply to workers with regular hours because they will continue to accrue 1/12 of the 5.6-week entitlement that they get. And also, employers will have the option to operate a rolled-up holiday pay for some, for the same cohort of irregular hours workers based on the 12.07% of earnings, and that includes overtime and paid allowances and everything else. So it's certainly a good win for employers. And then the final one is the UK visa requirements. For anyone who has sponsorship licenses and brings people over from overseas, it will see an increase in the minimum salary needed for a skilled overseas worker, and that increases from 26,200 to 38,700. The aim by the government is to cut the number of people coming to the UK by more than 300,000 people, and it'll also sort of ban health and care workers from bringing their families and dependents to the UK. And it's also looking to increase the charge to foreign workers to use the NHS from £624 a year to over £1,000 a year. So again, it's going to be an increase to employer costs that you're going to have to factor in. So whilst in some cases it's going to be good for employees with national minimum wage going up, with the national insurance cut and everything else, for employers, it's not such a positive sort of outlook, and there are going to be increased costs. And it's one of the reasons why we're running this webinar now, is to sort of forewarn you so that you can start budgeting for those increased costs and forecast for the future.
Lovely. One more question's come in. Can you remind me how much you can take out of a pension tax-free and at what age you can do this?
Unfortunately, I'm not a technical pension advisor.
Yeah, I did. It's broadly 25% of your pension pot, and normally from the age of 55. But I think specific rules can apply to various different pension schemes. So I shouldn't have put you on the spot there, Adam, forgetting you're not a pension specialist.
That's fine.
Right.
The best thing to do is always to contact your pension provider, and then they will be able to sort of give you exact amounts as to what you can do, because as Esther said, there are different scheme rules. So contact them. There's normally a free helpline number, and they'll be able to give you all the answers you need.
Yeah, pensions are a whole subject in themselves and quite complex as well. Right, so Sally, coming on to a few questions for you then. So, I mean, what's the best way to go about sort of communicating to employees the value of their benefits provisions?
A total reward statement is probably one of the best ways to communicate all of the overall employment package, and it's a great way to raise awareness and appreciation of all the reward programs that are offered. It shouldn't be a list to show how much an employee costs the business. It sort of what it needs to show is sort of base annual salary and the cash benefits, and then also all the benefits that are offered as part of the package. And that could be the employer benefits as well as any voluntary benefits. But a reward statement is also a good opportunity to share all the good things that have happened during the year. And also, if any benefit providers have got any particular good green credentials, also if the business has worked particularly well in certain areas of sort of green or carbon neutrality, sort of use this as a statement, not only to showcase the package, but also share good news. And don't forget also to include all of the well-being, sort of the health and well-being, the financial well-being, because sort of those are really, really key benefits now. And linking into a couple of points that Adam raised as well around, you get your data from payroll, and then make sure that it's used in the best way possible.
And what about if you use a benefits platform? Can you still make use of a reward statement then?
Absolutely, yes. And by using a benefits platform, actually, it just is another way of an employer enhancing the benefits that an employee has access to. Often benefit platforms also offer discounts at tills, online, and sort of high street shopping discounts. So include those. You don't need to put on a big list of these are all the benefits on the platform. Platform providers will be able to give a data set of those benefits that are used most, and even those that perhaps aren't used as much. So put on a couple of the better ones, the better usage of the benefits, and also remind, okay, these are some of the other benefits. And often if a benefit isn't used very much, it's because perhaps it's not as well known. Pension, everybody will often look at sort of pension, healthcare, but where you've got some of those voluntary benefits or some of those discounted benefits, it may be that if you do have a platform, an individual may not have gone on the platform for a while. So by including the fact that you use a benefits platform is a reminder, and will often be a good way to get usage and footprints back onto the platform.
I mean, attracting and recruiting talent isn't necessarily the easiest thing to do at the minute, particularly in sort of some industries, service industries, for example. So how might a reward statement help us to do that?
Well, I think what I've previously do is I've worked with recruiters and provided a statement, and it's allowed the recruiters to actually have a real in-depth knowledge of what that role entails, both sort of cash and the non-cash elements, and also be able to talk to candidates around, well, this is our company culture, sort of this is what we do around benefits, these are the levels of benefits. Even you could have on there around sort of career progression, and often what I've provided as well specifically for recruiters on a reward statement is I've given them a salary range rather than sort of just one salary point. By giving the salary range, it allows the recruiter and the line manager as well to understand perhaps where the candidate might fit better on a range. If they've got a particular skill, then they could be looking at slightly higher in the range. So it just gives some sort of thought process around, okay, we've got this salary, we've got this candidate, how best do we match it? But the statement, it's a cultural statement. It's about sort of selling the EVP of the organisation and why you are an employer of choice as well, because there's that real in-depth knowledge to be able to talk it through.
Everyone might not know what EVP stands
Sorry,
for.
so that's the employer value proposition. And actually, funnily enough, reward statements sometimes are referred to as a value proposition statement as opposed to a total reward statement, because it's leaning more towards selling the culture and all those good bits about working for an organisation. And a statement is often, when you think of a statement, you think of your bank statement or your mortgage statement. So that sort of, I think there's a move away from having a list of sort of numbers that aren't really sort of very exciting to look at, more on a statement of a value that shows what it's like and all the good bits of working for an organisation.
And what about small organisations with sort of very limited benefits and perhaps even less HR resource? How might a reward statement be advantageous to them?
It works equally well. Smaller businesses, they may not have the range of benefit provision that perhaps a larger organisation has, but I think it's equally important that that all businesses are able to showcase the value of working for an organisation. And with limited resource, I've worked with in-house HR teams to support their process in delivering the reward statements, just making sure that they've got the templates and that everything is in place. But I think it's a missed opportunity to not be able to share the value and all the good points of working for an organisation. So whether you've got sort of a very small handful of individuals working in your team, or whether you've got thousands, using a reward statement is a really good message that you can share with your people.
Thank you, Sally. We've got a couple of questions come in. Somebody's asked, how would a reward statement be shared with the employees? Would you do that by email or with their payslip? How would it be done?
Well, you can send it out by email. It's if you have Teams set up, you can send it out probably more securely through Teams. But whatever way you do it, you must make sure that you adhere to data protection sort of guidelines and regulations. So if you're sending a document out either on Teams or by email, it must be password protected, and they have to be individual passwords that are then shared separately with the individual. I've worked with organisations where they have done that. They've also wanted to have the hard copies, where line managers have wanted to personally hand statements out, albeit this has been to some smaller organisations. I've also worked with an organisation where they actually wanted to post out these reward statements. Just make sure that when you're doing that as part of the pre-prep, you need to make sure that home addresses that are kept on the system are up to date. Often I've sent out statements and they've come back because the individual has moved and they haven't updated their home address on the system. Mm-hmm. So there's some checking processes depending on whatever happens. They can also go with payslips, but that would depend on the setup of your payroll provider. Not all payroll providers can attach documents to payslips. So if you want to do it that way, first check is with your payroll provider.
Thank you. And somebody else has asked, where might we get a template from?
So templates, you can download templates from sort of the internet. There's a number of sort of free templates that can be used. I referred earlier, I've worked with in-house HR teams where I've provided sort of templates and the process. So there's a number of options. Some of the online templates aren't particularly good. As I say, the best ones don't have a list of numbers and finance. It needs to have that right mix of selling, well, not even selling, but actually sharing good news, and then what the individual package is.
Yeah. And then final question we've got is, when is the best time to issue a statement? End of fiscal year, end of calendar year, or when would you pick?
I think, well, it can be done end of calendar year or end of financial year. Often the statements are issued with P11Ds or P60s, because then that sort of falls in nicely with the other data that's being sent out by your payroll as well. So it really does depend. And of course, that can also depend and be determined by availability of the resource, those folk that are going to be pulling together the data and sending out the statements.
Lovely, thank you very much. I don't think there are any more open questions. So unless there's anything else that you or Adam wanted to talk about, then everyone's got 7 minutes back in their diary, which I'm sure you'll all be delighted with. So thank you very much, everybody, for attending. Please do fill out the feedback form. Like I said, it's super useful for helping to shape future webinars. And like I said, it was recorded, so do share it with anybody who wasn't able to attend this morning. So I think all that is left for me to say is to wish you a very Merry Christmas. I hope everyone enjoys your festive break, and we will see you back in the new year for end of year tax planning. Lovely. Thank you very much.
Thanks very much, everyone.
Thank you. Bye.
Bye-bye.